Good afternoon, everyone. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Bob McNally, president of Rapidan Energy Group. Thanks so much for joining us today, Bob, and a lot to talk about.
Great to be with you. Thanks for having me on, Diala.
Yeah, and since we last had you on this particular podcast, I think it's been about a year, so a lot of developments, on the geopolitical front in the energy markets, and also on the U.S. Domestic front, of course, politically, and how that might be impacting both the U.S. energy space and, of course, the international energy space. So let's get cracking. Let's start with talking about the most recent sort of development that could impact, global oil markets, which was the U.S. and Russian representatives meeting last week to talk about the Ukraine and the Ukraine-Russia war. But, not to get too much into the nitty-gritty of that, but let's make some assumptions and say that by June we'll have a ceasefire or perhaps, a complete end to that conflict. Now, what impact do you think that'll have, if anything, on, for example, Russian oil flows, if at all, and on also on sort of U.S. sanctions that Trump is in parallel still considering to continue on Russia?
Right. So if we hypothetically assume that an armistice or a peace agreement includes the relaxation of energy sanctions, I think it's a bigger deal for, say, the price of Urals versus Brent. It's more for the spread there than it is for the flat price of oil, Brent, what have you. And that's because, on purpose, the Biden administration and the Europeans designed oil sanctions to enable Russia to sell oil. They were shocked by that price run up in 2022. And they went to India and basically said, take all the Russian oil you can. Now, on the way out of office, President Biden implemented tough sanctions. And if President Trump keeps those, then we might see some Russian oil go off. We say about 500,000 barrels a day later this year, if he keeps the tough secondary sanctions, especially. However, to your question, if we saw the sanctions come off, because not a lot of Russian oil has left the market, easing sanctions shouldn't have too much of an impact. I think, again, the Russians won't have to sell at such a discount anymore. Urals Brent spread will come up. But I think it's a bigger deal for natural gas, really. If we imagine that the Europeans would reopen to Russian pipeline gas, again, I don't think this is very likely, but in this scenario, I think that there would have a bigger impact on prices and flows and LNG projects and so forth than oil.
Of course, yeah, and there's a split camp on that, isn't there? Some people saying Europe's going to have to go for the best price gas, as it always has done, and it'll take what it can, essentially. Others saying no way Europe's going to go back to that. They've learned their lesson. Yeah, interesting. Okay, well, let's stick to the sanctions topic and talk a bit about Iran as well, because we just saw fresh headlines coming out of the Trump camp yesterday, about the imposition of stricter sanctions on Iranian oil. And, again, the market seems to be split on that, because some would say, this is rhetoric, but Trump still wants, low oil prices. So how would he really impose strict, a real cut on Iranian exports? And the other side of it is, of course, to do with the US-China relationship, because at the end of the day, it's Iranian oil is going mostly to China, isn't it? So again, how likely do you think that will play out to make any difference in 2025 to what we see as actually increased Iranian oil exports really in the last year or two under the previous Biden administration?
Right. No, since last spring, and in the face of much skepticism, Rapidan has been telling clients, if elected, President Trump has the means and the will to reimpose maximum economic pressure on Iran. And that includes reversing the Biden administration's allowance for Iran to resume its exports, as you noted, almost entirely through Malaysia to China. About 1.5 or so million barrels a day going to China. And President Trump has understood that the key to that is China, as you mentioned. And so we're starting to see, and we saw yesterday, the sanctions going into effect on tankers, but that's really a game of whack-a-mole. That's not really going to get the job done in the Trump world. The Trump folks believe and have been planning that the key to getting Iranian oil off the market is to go to China and threaten them with secondary sanctions. If the United States sees Iranian oil continuing to show up in Chinese ports, we will impose secondary sanctions on all entities in those ports that deal with the United States. And while China no doubt has enjoyed ripping a discount from the Iranians and paying in renminbi, they have other fish to fry with President Trump. And so we think China has been and will continue to accommodate President Trump on that. I do want to say, though, President Trump sees sanctions and getting Iranian oil off the market as a means to an end. He does want a diplomatic deal, but he believes he must recapture the leverage that he believed he had in the first term when he got Iranian oil exports down to about 500,000 barrels a day. And they regard that as a huge success that they want to replicate. They think President Biden made a big mistake by letting Iran out of jail, so to speak. Got to put Iran back in jail, get their oil exports off, and then hopefully, in Trump's view, negotiate a agreement on the nuclear program.
Right. Okay. Exactly. I mean, you were referring to the nuclear program, and of course that ties into so much else in the Middle East in terms of the shifting geopolitics, and of course the Iranian proxy equation in the region, which of course has undergone a tremendous shift in the last year. We won't sort of delve into that too much, but of course from a market point of view, waiting to see. But again, we have plenty of supply, don't we? So even if we see Iranian exports a shift, dramatically, even if we see and we see Russian oil, shift around to get it more. I mean, this question and challenge really of oversupply at the moment for producers. Clearly, you're trying to protect a certain price, both U.S. producers, you would imagine, and OPEC producers. Where do you see that balance, do you think, going forward this year? The oversupply that we began to see last year, continuing into this year, no improvement expected from a demand point of view either. So how do you think OPEC and non-OPEC producers are going to manage that?
Yeah, so from a strictly barrel counting perspective, when my analysts and I look at the market, we do see it amply supplied, with risk to a soggier market, mainly from weak macro, especially in China, especially in diesel in the market there, but also the skew of risks are bearish because of trade war risks and tariff war risks and so forth. So in a way, an involuntary cut by Iran, as one might characterize sanctions pressure, of, let's say, 1 million barrels a day or so, might be sort of just what the doctor ordered in terms of putting a floor under crude oil prices that might otherwise have a directional skew down, again, because of weak demand, not because of structural factors. Rapidan has never been in the peak demand camp, but no question macro is weak, particularly in China. And so, and non-OPEC supply growth has been fairly decent. Well north of 1 million barrels a day, Argentina, United States, Guyana. So therefore, the loss of Iran from a strictly barrel counting perspective is not necessarily hugely bullish. However, we have to have a big condition and asterisk here. If Iran responds to the loss of its exports by reviving its attacks and its proxy attacks on Gulf flows and infrastructure, then all bets are off. Then we could see a meaningful geopolitical risk premium come back in the market.
Yeah, I mean, that's interesting you say that, because I mean, that's probably unlikely to have, who knows what happens, but I think the markets discount that. But even last year, Bob, when we saw Iran's proxies more active on the shipping routes, the risk premium, I mean, it was there, but it was stable, and it didn't really, I mean, yes, it shifted up and down, but it was still, I suppose, deflated compared to what it should have been, considering the activity we were seeing, which again, many people are attributing to the demand supply scenarios. I mean, talking about non-OPEC supply, let's talk a bit about US production, because again, we saw, the end of last year, a bit of an increase, obviously, throughout the year in US production, but a lot of people saying in the year ahead, not so much expected, maybe in total liquids, but that, private producers aren't that incentivized under these prices. What would you say?
Yeah, so we see modest growth in total liquids, maybe 800,000 barrels a day year on year, split between crude and NGLs, going down to about a 500,000 barrels a day in 2026, split again between crude and NGLs, and then sort of plateauing. The growth otherwise is coming from Latin America, as we discussed. Now, this is a bit of a shock. In 2022, when oil prices soared after Russia invaded Ukraine, and gasoline prices in the United States hit an all-time high. The Biden administration ran around, you may recall, saying, "Oh my gosh, shale has got to increase." They were hoping that shale could sort of turn a spigot, and suddenly more oil would come out of the ground. And they learned that that isn't how even the shale oil industry works. And now, though, you have President Trump and his team who are desperate to drill, baby, drill. They want to see much more oil production so they can get oil prices down to solve their inflation and, they believe, Russia-Ukraine war problems. But the situation is the same. You have a very cautious oil sector. Look at the Fed surveys when we talk to our clients, look to the earnings calls and so forth. The investors don't want shale companies adding to rigs.
Yeah.
They are becoming more efficient. They're squeezing more barrels out of the existing operations. But this is not the go-go years of 10 or 12 years ago. Absolutely not. They fear and they remember the oil price collapses of 2020 during COVID, 2015. They look at this wobbly macro environment that we're discussing here, and they're very cautious. So we're not in a kind of a drill, baby, drill environment in terms of increasing beyond the 500,000 to 600,000 barrels a day that are sort of baked in already.
Okay, I mean, just so back to sort of US and OPEC plus, I suppose. I mean, Trump, continuously asking Gulf oil producers to keep prices, a lid on prices. These cuts that they've done have essentially sort of saved the price for most producers, including the US. God knows what would have happened to US producers had the price dropped to $60. I mean, their marginal cost per barrel of production is much more sensitive, isn't it? But let's talk a bit more big picture in terms of how you think. I mean, you've just been in the Gulf yourself. How do you think Gulf oil producers are receiving this call to, keep supply plentiful, but at the same time, they're in a position where they're having to balance the market, take that onus, particularly countries like Saudi Arabia. And how is that playing into the diplomacy that we're seeing also at play in the Middle East with the current, obviously, critical problems between in Palestine and Israel, etc. And we mentioned Iran and their proxies. How the Saudi-US relationship, I should say, how do you think that playing out this year? More sensitivities at play.
It is, but the Saudis have been here before. In the beginning of the Trump administration, there was heavy pressure from President Trump, public and private, to lower oil prices. Then, of course, in 2020, when oil prices collapsed, President Trump flipped and started calling Saudi Arabia, asking them to cut production to raise prices. So they've seen both movies before. I do think there's a separation between oil on the one hand and then geopolitics on the other. The Saudis and the UAE and OPEC Plus take oil stability very very seriously, and they've been successful in the last 6 to 9 months, especially in keeping the oil price stable. Matter of fact, you could say OPEC Plus has been the one area of policy and geopolitics that has been stable and effective, and they don't want to lose that. I think they're going to resist pressure to flood the market and crush the price of oil. They will wait to see the market tighten up, I think, before they add barrels. They remember 2018 when President Trump was planning to impose sanctions on Iran. Saudi Arabia increased, oil prices rose to $85 a barrel, and then in November the president decided to delay the sanctions.
Yeah.
And prices collapsed. They don't remember that very well in Riyadh, I can tell you. Also, they don't want to look like you're throwing Russia under the bus either. Keeping Russia in the OPEC Plus fold is very important for stability there. And finally, they can count barrels too, and they see these risks, and they don't want to oversupply the market. So I think they'll resist the pressure to increase production. But I think in other areas, whether it's mediating between Russia and the United States and other areas, I think the Saudis will get along very well with President Trump. They're working closely together with the U.S. So there's a sort of separation there.
Okay, let's talk a bit about US-China again. I mean, and the tariffs that have been imposed at the start of the year. Obviously, the US started with the Canada-Mexico tariffs, sort of pulled those back a little bit to 10% and delayed the implementation. We're going to hear more about that next month. I want to ask you about that, but the tariffs on China in terms of trade, and of course China now, of course, having responded to tariffs on LNG, etc., US LNG. How significant has that been so far, do you think, on both sides?
So far it's not been terribly significant. However, it's going to grow over time. The significance will grow over time, we believe. So the strategy, the Trump administration, is to again get into a big negotiation with China. Other presidents, they split things up. Trade's over here, defense is there, human rights over here. With President Trump, everything is on the table. Iranian oil imports, EVs, technology, TikTok, tariffs. So everything gets put on the table. And the president is going to put in place these tariffs as sort of a starting point. And then with them on the table, try and have a larger negotiation with China that will settle most of these things. I think this is not going to resolve itself quickly. I think it's going to take time and ramp up. But I don't think you'll see necessarily abrupt increases. I think the President Trump wants to gradually increase the sanctions pressure while discussing these other issues. There's a lot of issues that the president and the Chinese President Xi have to discuss, and this is one of them. So I think it's going to be a slowly unfolding and intensifying factor.
Okay, and more clarity being given to markets, I guess, over time. You mentioned EVs, Bob, in China. Let's talk a bit about first of all, Chinese oil demand, but in the context of, yes, a rapidly expanding EV sector and uptake, also, LNG for trucks, etc. How much do you think that is playing a role in the weakening of the China oil demand story? I mean, not necessarily getting into figures, but is it something we're going to see, take a bigger chunk out of that pie in the next 4 or 5 years?
It's having an impact, Diala, but my colleague Gifei Li runs our China advisory service, and our demand analyst, Linda Giesica, when we look at it, we think there's a lot of hype there. No question, LNG trucks have taken out about 400,000 barrels a day of diesel demand. However, LNG trucks are not enjoying the sort of state subsidies and support that electric vehicles have. And I'll come to that in a second. And that LNG displacement really depends on that gas oil LNG spread, which whips around. So it's an important factor. It's having an impact, but we don't think it's structurally going to displace an enormous amount of diesel going forward. With EVs, there's a lot of hype. You see the figure, half of Chinese sales are EVs. Well, no, they're really what they call NEVs, new energy vehicles. And about half of those are purely electric vehicles. The rest are plug-in hybrid electrics. And so while we think that is having an impact, we see more of a gentle rise in gasoline demand as the population grows. I mean, they have half the per capita vehicle ownership of South Korea. This is a country that's going to drive more. And you remember, China, one of the reasons China put so much money and support into EVs is because it thought it was going to be able to take over the global industry and displace the United States. But if there's one thing even the left and the right agree on in the United States, Canada, and now Europe, is that they're not going to allow Chinese EVs to take over the world. So not that it's going to go away or diminish, but we think we see more of a sort of gently rising plateau for gasoline demand. It's become fashionable in some quarters to predict a peak and collapse in gasoline demand in China.
Yeah.
We don't see that at all.
Okay, and what about the structural sort of government initiatives that are happening in China? The sort of stimulus measures, I should say, that have been sort of implemented gradually, on and off through in the last year or so, and will continue supposedly into this year, trying to sort of deflate also their currency, maybe for trade purposes. From a sort of impetus for oil demand, do you think that's going to possibly kick into effect a bit more effectively this year or not? I mean, last year a lot of people criticized China for doing too little too late in terms of the government stimulus to really get that consumer confidence back.
Right. Only a little bit, Diala. The potency of stimulus, spraying money at infrastructure projects to goose diesel demand, for example, what we've seen many times before. that is weakening. And we have China growing at about 200,000 barrels a day this year, maybe 200,000 barrels a day next year. We think stimulus might be able to prevent a contraction. But China has huge headwinds. It's enormous debt. It's troubled property sector. And
Yeah.
then these trade pressures that it's being subjected to by President Trump, by the Europeans, and so forth. So it's hard to overstate that. And, spraying more money, issuing more debt, and throwing money at concrete projects and things is losing its potency. So yes, a little bit of an impact, yes, but not a huge one. And in our view, China's demand growth will be pretty muted.
Okay, let's talk a bit, circle again back to sort of Trump, but the tariffs on Mexico and Canada. I just want to talk about that, energy tariffs in particular. I mean, that seems to be really shooting the US in the foot, doesn't it? If those do indeed go ahead in any way, in any big way, cutting itself off from Canadian, especially energy and exports, obviously, as well in the US's case. Do you really think that's going to happen?
Well, you can't rule it out. But if it does happen, we saw the president decided to lower the proposed tariff on oil. He is very sensitive to crude oil, gasoline prices, and so he lowered that to 10%. And then just yesterday, he called for Keystone to be built right
Yeah.
away. So look, I think the odds are that he won't impose those across the board tariffs on Canada and Canadian oil and Mexico. I think that was really about sort of an opening shot to elicit concessions on border and fentanyl, and both Canada and Mexico are making moves in that direction. Now, there are other tariffs coming in place on steel and aluminum that are maybe a little more likely down the road. But I think these specific ones, my odds would be slightly in favor of more of a delay while they continue the negotiations. You know what I think what they're really after is to renegotiate this USMCA, the successor to the NAFTA treaty. I think an early reopening of that and a broader trade discussion, along with the fentanyl and the border issues, is really what they wanted. And so I think if they can get that, they'll defer. But it's not a slam dunk. There's a possibility he will proceed with them.
Yeah, and of course you have the other side of the equation, which is what they're doing with Europe in terms of where those particular potentials of tariff threats, I suppose, materialize. And I mean, you've had a lot of triggers there. You had the vice president last week going to Europe and obviously rustling a lot of feathers there. But again, as you said, it's all looking more as time goes on now, 1 month into the Trump administration. It's as you said, there's sort of shots which are sort of really all they want is reaction, and then they're going to make up their minds about what they're going to do. Bob, before we let you go, in terms of sort of oil price trajectory, not to ask you to give us a forecast, but we've had short-term volatility because of these macro trade sort of uncertainties in the market, but we've had a pretty steady range in the last few months, really, for oil, steadier than we've really seen in the last sort of 3-4 years. This range of sort of 70 to 75. And many people calling that by the end of the year, that'll be in a $5 range that's a bit lower than that. Would you say that's the sentiment right now, given demand, given supply?
I think so. I think the supply and demand equilibrate fairly easily here in the $70 to $80 range. However, it's the black swan risk, right? Iran, I think, is a huge issue this year. One way or the other, I think Iran's nuclear program will be set back, either through a diplomatic deal, which could be bearish for oil prices if sanctions are released, or through military action, which could be very bullish. So you've got that, and you also have the macro risk. And so I would say yes, but yes, we equilibrate. If you look at, demand growth of around 1 million, supply growth outside of OPEC plus at about the same. If OPEC plus continues to show this unity and preemptiveness and precautionary attitude, one could reasonably expect for the next few years oil prices to trade where they are. However, we are and remain very bullish medium term. We think that the market is in the foothills of a next boom cycle structurally. I think it's very important. We saw the IEA come out and say last week that they are reconsidering their peak demand forecast and may bring back a forecast that doesn't show that shows strong demand. We're seeing every day, BP, elsewhere, this credibility and belief in peak demand and declining investment sort of fade away. And so I actually think this is the year that the idea of peak oil demand will itself peak. And so that should affect sentiment, I think, medium term in a very bullish direction. So a lot of air pockets, a lot of risk, a lot of mines in the ground near term, both bullish and bearish. However, medium term, I think the outlook is extremely bright for both oil and gas producers.
Okay, and you mentioned, Bob, before I let you go, actually, I just came to mind now. You mentioned, obviously the likes of BP sort of withdrawing their sort of previous, transition commitments and wanting to put more towards oil and gas. Just from a US perspective, and just looking at the IRA bill, which obviously is very much was funding and giving tax breaks to investing in new energy technology, apart from anything else. But it did include a lot of grants for that. And that should fit in well with Make America Great Again, or Make Things in America that Trump wants to promote. But that is under threat, isn't it, under Trump's policies? I mean, he has said he's going to withdraw, what is it, $400 billion of funding for such projects. That seems a bit counterintuitive. Maybe not for the oil and gas upstream sector, but certainly for US manufacturing.
Well, so yes, the president is very opposed to the IRA. It didn't have a single Republican vote when it passed. Even moderates like Senator Murkowski and Senator Collins didn't vote for it. The view is way too heavily tilted towards renewables and electric vehicles and expensive energies that don't really improve our energy security. However, Republicans like bits and pieces of it, right? They like the hydrogen incentives. They like the carbon capture and sequestration incentives. There's bipartisan support for the biofuels. So I think they will pick a few pieces from it to be saved, but most of it will be repealed and then the spending not spent because there's just not the support in the administration for it. Also, the big cloud over Washington these days is pressure to reduce spending, right? We have to pass this tax bill. So while we're all focused on Panama and Greenland and Russia and all this other noise, in Washington, everyone wakes up every day thinking about how are they going to extend this tax bill? How are they going to find spending cuts? And that pressure is going to lead to more of the IRA, I think, being repealed, and those few bits, I think, perhaps being saved.
Yeah, and other things being repealed, of course, across many fronts. I mean, that is definitely a very clear policy coming from Trump, that he does want to cut spending, including defense of other countries, if you like. So we'll see how that all unfolds. Bob McNally, president of Rapidan Energy Group, thanks so much for joining us today on Halftime Talk. It's been great to have you.
Thanks for having me.